bull markets in precious metals are more than insurance. They are more than a hedge. You've simultaneously got insurance and a hedge and these huge potential gains. Hi, this is Mike Maloney, and I've got Adam Taggart with me once again. Adam, how are you?
I'm great, Mike. Always a pleasure to be back with you.
You recently did an interview with Rick Rule, and I watched it, and it was phenomenal. And so can you tell us a little bit about it?
Absolutely. So as anyone who's seen Rick before, Rick is he's a wonderful explainer. And I know that he appeared in your Hidden Secrets of Money series, Mike, and did a great job there too. But yeah, I was interviewing him on a number of topics, but of course the topic of precious metals came up. And Rick had this quick segment here that I thought just really did a great job of explaining in just a really hard-hitting but understandable for everybody kind of way about how having gold in your overall portfolio is some of the best insurance that one can have. Why don't we just play the clip?
It doesn't take very much gold in your portfolio to hedge against the sins that happen elsewhere in your portfolio. And to the extent that investors don't hold gold, and by gold, I mean physical gold or physical proxies in their portfolio, those people are in effect uninsured, which I believe, unless they are extremely rich and can self-insure, is very stupid. I don't think that in the first instance, people should buy gold just because they think it's going to go up. I think they should buy it as a way to maintain their purchasing power over the rest of their useful lives.
Yeah.
Buy it and in fact hope it goes down, because gold is insurance in its purest form, a medium of exchange and a store of value.
So Rick, would you say that just like the market fell in love with the Fed put over the past 15 years?
Yep.
Are you saying that investors should fall in love with the gold put going forward here?
Fall in love might be the wrong phrase. Do you love life insurance? Do you love home insurance? I think it's the responsibility of a mature adult to organize his or her life in a way that will give them the best outcome. And I think gold is an absolute component of that. I have no idea what's going to happen in terms of my mass psychology. I'm talking about your listeners taking action themselves to secure their well-being.
Great. And the insurance analogy is a great one. I just, in the heat of the moment, listening to you speak, I was like, that's basically what gold is, though. It's a put on your the purchasing power of your capital, right?
That's exactly what it is.
Wow, that was phenomenal. You know, one of the things about Rick, if anybody watching this gets a chance to see Rick live, please do so. He is the most eloquent speaker that there is on the subject. He is just wonderful. And he's very approachable. I mean, after the events and stuff, he does make himself available. And he is a very kind, warm person to have a conversation with.
He is. He really is the hardest working man in hard assets.
Yes, right. So, you know, I want to show you, though, this, you know, you were saying in that clip that gold is basically like a put on the dollar. And so it's hedging against the dollar going down.
Right, specifically on the purchasing power of the dollar, but yes.
Yes, and he was talking about that gold is insurance. And yes, during normal times, that is true. But if you take a look at this chart from my first book, Guide to Investing in Gold and Silver, now, I apologize, it's black and white. I wish that this was in color so that I could have three colors and these lines would really stand out. And my chart maker just absolutely refused to make these lines more different. So we have a thin gray line, a thick gray line, and a black line. The black line is the Dow gold ratio. And so this is ounces of gold, the number of ounces of gold it takes to equal the points on the Dow. The thin gray line is homes priced in gold, and the thick gray line is Robert Shiller's PE ratio, and this goes all the way back to 1920. So all three data sets on one line, and you can see that there's a cycle in here. This cycle that we are in right now really hasn't completed. This one stops in 2007, but it didn't get back. Things didn't go to undervalued, whether you measure it in real estate or PE ratios or stocks against gold. It did not visit severely undervalued territory. It came down toward fair value and then bounced back up into a bubble, which is now deflating. So it's similar to what happened in the 70s. There was a bounce in the middle, but when the black line here, the bold black line, is going down, that means gold is going up in purchasing power. That is the value of stocks falling compared to gold. Now, with real estate in the 70s, if you had sold a home in 1970 and purchased silver, you would have been able to buy, I believe it's 17 similar homes. It's just 8.5 years later that gold and silver reached their peak. So August 15th of 71 is when gold became free trading. So the potential gains in purchasing power, bull markets in precious metals are more than insurance. They are more than a hedge. You've simultaneously got insurance and a hedge and these huge potential gains. And that's the reason I just can't figure out why anybody would recommend 10% of a portfolio in gold. Or, when this black line peaked at 45 ounces of gold required to equal the points on the Dow, ever since then, it has been more profitable to be in gold than it has been in real estate or stocks. There are these brief periods of time where they way outperform gold, but from 2000 until today, the place to be really has been gold, except, we've had the bear market from 2011 to 2015. So there was 4 years of bear market in the middle of this giant secular bull market. And the reason I don't try to time these cyclical corrections within a major cycle, this secular bull market, is because you never know when these things are going to happen and when they're going to end. And when you jump in and out, you're probably going to be out when everything moves. And then you're not just out, you're left out. So I pay attention to this, and gold is much more than just insurance. It's much more than just a put on the dollar. But
that's great, Mike. And as you could see when I was talking to Rick, this idea of the put just sort of popped in my mind as you're talking. It's not to get too wonky, but the idea of a straddle is popping into my mind. Which for those that aren't very familiar with options, it's a pair combo with a call and a put. Basically, it's giving you both downside exposure and upside exposure. And in a lot of ways, I think what you're saying, Mike, is gold's actually almost more like a straddle here, where, in normal times, it's going to, protect the purchasing power of your wealth, that you're not going to lose, purchasing power being in it. But there are times, like you said, where its purchasing power dramatically increases versus all other things. And I think it's really important to remember as a precious metals investor, the goal is not to die with a bunch of, ounces of gold, right? The gold is supposed to be a means to an end, not the end itself, right? So you want to be looking at this chart that you have, Mike, or chart of gold versus whatever assets you're interested in, and be able to know when you're in an attractive period to exchange these precious metals for the real thing that you want to have in your life and enjoy, right? And I think, we're kind of seeing that play out right now in the housing market, right? Where housing, was appreciating by leaps and bounds in price relative to gold leading up to 2001. Then we had 2022, where gold was one of the only assets that held its own. And now the housing market is really beginning, to very clearly roll over here. How far down it goes, we'll see. But you're very likely by the end of that cycle going to be able to buy a lot more house with gold than you were before.
Yes. And now you're talking price versus value, and that's the value. And the value of the amount of real estate each ounce of gold we'll purchase is going to go up by a factor of many, many times. That is the thing. And you only get these opportunities a few times in a century. If you look at this chart covers almost a century of data here. It's old. I published this in my book that came out in 2008. So this chart only goes up to 2007. But you only have this opportunity just a few times in a century. And the opportunity is here right now to both protect yourself and expose yourself to these gigantic gains at the same time.
Well, and that's where I wanted to go real quick, Mike, which is you've just written another book, and I believe you're releasing it now because you think this is the next big upcycle.
Yes. I'm trying to time it with the this next wave that I can't tell you the title yet, but within the next 2 weeks, it should be on the market, and I'll be able to say the title very shortly. So anyway, let's get to the quote of the day, which goes very well along with this video and everything that we have just said. Gold and silver are money. Everything else is credit. J.P. Morgan. I want to thank everybody for watching, and thank you for joining me, Adam.
Always a pleasure, Mike. See you next time.